Okay, thank you very much, Jonathan. It is a real pleasure the opportunity that you give us to present here our work at this such a renowned the virtual Israel macro meeting. So during the next hour, we will talk a little bit about our latest paper. It is co-authored with Tomasa Rodrigo, which is here with me, and Pablo Saborido, that is here as well. And the title of the paper is Geopolitics, Geoeconomics, and Sovereign Risk, different shocks and different channels. The paper or the work, it is heavily relying on test analysis and machine learning approach. So we will dedicate a little bit. It is not changing the outlook. Okay. We will be a little bit of time dedicated to some technicalities. During the first 10 to 5 minutes, I will dedicate a little bit of time to show you what are the key questions and the key results of the paper, and also the key technical contribution coming from test and the machine learning approach. So the key question of the paper is whether the geopolitical or geoeconomic shocks impact sovereign risks through the same transmission channels. And the immediate answer, it is not. Both channels, both geopolitical shocks and uncertainty and geoeconomic uncertainty widen sovereign spreads, but through different channel signatures or pattern. The geopolitical shocks transmit primarily through direct effect on sovereign fundamental repricing, but it is partially offset by a compressing global financial channel, what we call the scissor pattern, reflecting two different forces moving in the opposite direction. The second, the geoeconomic uncertainty shocks increase risks bypassing the direct effect, and it do it mainly through indirect channels, basically the macro and uncertainty channels. There is also some heterogeneous results on the heterogeneous nature of geopolitical shock effects. The effect is the persistence of the shock. The direct effect, the fundamental repricing direct effect, persists over time, but the financial amplification or of absorbing a shock mean reverse much more rapidly. There is also, we confirm the existence of the gravity effect on the geopolitical direct effect. So geopolitical peace, direct geopolitical effect decay with distance from conflict, reflecting the traditional gravity of conflict literature. However, the uncertainty shocks, for example, in the geoeconomics shocks, activate globally. They are not have such a gravitational effect. Finally, we find what we call the originator penalty. So those countries which are directly involved in the conflict, it could be, for example, today, Israel, Iran, and the US face widening spread due not only to direct but also deteriorating local macro conditions at the same time. Okay. On the it is not now. It is now changing. On the data methodology contribution, we have several contributions from the data. I will elaborate a little bit later. We rely heavily in high-frequency BBVA research database. It is a novel daily panel. We include for the model 42 countries, but we will see later that we have more countries included. Actually, from 2018 to today, to the last week, using news coming from the GTL. It includes advanced and emerging markets, so we can make an asset class differentiation. And we have several, we combine market information with test indicators. And in the case of the test indicator, we use also different modalities using tone and coverage, but also, for example, distinguish between local and foreign language dependent of the indicator. Then, with big data, we implement what we call the three-layer methodology. which is based in the estimation, in the interpretation and validation of the results. In the case of estimation, we rely for several reasons that I will explain later on machine learning to deal with the non-linearity. What we find basically is that the nonlinear models outperform the linear ones. The second finding is that news matters in terms for analyzing the geopolitics and geoeconomics, but the way you include in the model matters too. So you can fully exploit the advantage of this test analysis when you use nonlinear models. And the main reason is that these indicators are mainly nonlinear. Once you decided to opt for machine learning, you have to deal with the interpretation issue, with the black box nature of the machine learning models. And for that, we use the traditional Shapley value, but also the Shapley-Taylor decomposition. Through the standard Shapley-Taylor values decomposition, we can understand the different geopolitics and geoeconomic shocks. But we introduce also some novelty here. It is that we disentangle the direct effects and the interaction effects of every of the channel by using the Shapley-Taylor methodology as well. Last but not least, you have that using machine learning, it is better to exploit the nonlinearity, but it has also some critiques in terms of the identification and so on. So we dedicate a big part of the paper to cross-validate with the standard linear models, in this case with the up-to-date local projection and structural VAR sign precision model, that the result that we obtain are pretty in line with these methodologies as well. Okay, let's start to describe the database. Okay, and on the database, you see there a QR. This is an open source database, so you can enter there. In the open public for public database, you have 1 year of every indicators on daily basis, and this is the database that we use to follow geopolitics and geoeconomics in real time in our research department. We have different indicators from economic sentiment, activity indices, economic policy uncertainty, a la Bloom, trade policy uncertainty, a la Caldara and Jacobello, geopolitical risk, also in line with the work of these authors. But we include also political tensions, protests, conflicts, and bilateral tensions, bilateral countries' relation, country to country indexes. At the end of the day, what we have is more than 2,250 indicators for 69 countries, although the ones that we use for this for the model are somehow restricted. I have prepared some of the information updated up to the last week. One of the things that, for example, we can observe in the first graph, it is the geopolitical risk index by countries, and there you can see that at the end of the February, there are some countries like Israel, United States, and Iran jump to more than 2 and 3 standard deviation. All of the indicators are standardized, so normality is between +1 and -1. And you can not only follow what happened with the United States, Israel, and Iran, but also with some of important neighbors, for example, Saudi Arabia, Qatar, and more intensely, even, for example, in the UAE. All of this information allows us, for example, to monitor the economic policy uncertainty across the world. This is our heat map. It is ordered by developed markets, followed by the emerging Europe, North Africa and Middle East, Latin America and Asia. And where you can see that economic policies uncertainty has been present since the end of the last year, at the end of 2025. It was present also at the beginning of the year, at the beginning of the 2026. We can zoom in out In this case, on the right, what happened to the developed markets, emerging Europe, North and the Middle East, because these are the areas who are closer to the conflict, to the Iranian, Israel and US conflict. And what we observed, it is at the end of March of 26, we started to see some darker, meaning decreasing economic activity sentiment in most of the Gulf countries, including Iran and including Israel. And what we see is start to some darkening in the developed markets, not excessively intensely, but some of the, for example, of the emerging Europe, including the Bulgaria and Croatia and Russia, continue to be in a very risky economic sentiment in this. You can explore the web and to monitor your countries and the set of the 7, 8, or 10 indicators for every of your countries in the web page. And again, this is the QR there. So let's start to comment how we organize this information for the paper. Just one moment. It takes sometimes to change. So what we are going to do in this paper is to try to explain sovereign risk. By sovereign risk, I mean credit default, sovereign credit default swap, standardized from the geometric average, daily geometric 28 geometric average from 2018 to now. Why the geometric average? The issue of smoothing the time series with the 28 moving average, it is just to clean up noise from the news, but we want it to be somehow maintain the high frequency spirit, so we use this geometric rather than arithmetic average. So in that sense, for example, 70% of the information falls in the first week and 90% will be in the second week. So in the first 2 weeks. So in that sense, the indicators maintain this up-to-date of real-time spirits. And we have divided what, or try to explain what happened to sovereign explain through different channels. The first channels will be including geopolitical variables. And here what we include is our geopolitical risk index. Relative to, for example, to Caldara and Jacobello, this is a little bit different. We mix here sentiment or tone with coverage. The original one by Jacobello and Caldara, it is only coverage. But we think that it is not the same to talk about geopolitics and conflicts in terms of, for example, bombing or high intensity of the conflicts, than in terms that, for example, we have been hearing these days. It is in terms of potential truths and potential deals of peace. So this is the different, the mainly different of our index with the standard ones. The second part of this. Yeah.
Val? Yes, we have a question from Jamel Sadawi.
Okay, Jamel. Tomasa and Pablo, you want to jump?
Yes, please. Thank you, Alvaro. I have 2 questions, actually. The first is about relative to GDELT data. How do you separate the selection of events vis-a-vis geopolitical events and political events? That's my first question. And the second question is about, don't you think that using the tone is creating a media coverage bias and maybe blur the identification? Thank you.
Yeah, for the first question, what we did in each case is to try to do different exercises for compiling the most relevant keywords or topics to monitor the particular issue. So in the particular case of geopolitical risk, we work closely to the methodology developed by Caldara and Jacobello, trying to identify topics that are close related with crisis, war, the diplomatic discussion, and according to all these type of topics, we build different set of keywords and topics developed by the GDL database in order to capture all the news that are speaking about this issue. In that particular cases, we also build different robustness analysis in order to make sure that the topics that we are closely monitor are the ones that actually we want to. So that means we get all the URLs that are speaking about these particular topics that we are monitoring, filtering them, and then we also work with natural language processing in order to see if the actual set of URLs that we are getting are robust enough for monitoring the exercise. And we also did this robustness check comparing with Caldara and Jacobello, other indices that some central banks has, and this was the way of proceeding for building the final indicator.
Okay. On the second set of indicators are global financial variables. They are not coming from tests, which is the US 2 years bond. This is following Swanson, and this is just to avoid the zero lower bound to get the Fed official rate. And the second is the standard global volatility VIX index. On the geoeconomic uncertainty variables, we decided to use local language rather than a foreign media. And the main reason it is that we consider that these are in the local media, for example, in Spain, but also in the emerging markets, it's very difficult to go to the portrait of the Wall Street Journal or so on, in line with the work of other central banks like the Bank of Spain. They have found that it's more useful to use the local language rather than using the Financial Times, the Wall Street Journal, and so on. That because you will have a more complete idea of what is happening in the local economies of these countries. This is also used in the local economic sentiment variables, in which we include interest rate sentiment, and here we combine tone plus times coverage, economic sentiment, which is our economic activity index, tone and coverage, and political risk, tone and coverage. You find here some of the questions when we present this. It is you are not including debt dynamics and the work it is about the sovereign risk. We are not included directly, but indirectly, if you see the latest group, we include interest rate and economic sentiment, which is a big part of the equation of the traditional standard debt dynamics. So we are not including directly the levels of debt because it will be very difficult to obtain this data on daily basis, but we indirectly include this.
Thank you very much. Yes.
The second is the set of countries, again, with this 28 geometrically weighted moving average for 42 countries. And it was important for us to distinguish between safe asset developed markets and different emerging market regions, including Asia, Latin America, emerging Europe, Middle East, and North Africa. The ones that we are in gray are not included in the model, maybe because we didn't complete the full database at that time, or maybe because they don't have credit default swaps in indicators, okay? But this is, we think that the world economies are well represented here in this set of countries. If we move to the next one, we are going to discuss the machine learning methodology, and we are going to enter in the 3-layer sequence system. If we move ahead, we will take just a minute to discuss the theoretical benchmark, so what to expect from theory before we enter in such a quantitative framework. Okay. We dedicate some part to the theory and in the appendix of the paper to the micro foundations also of the literature. We here describe, for example, the two shock families, geopolitical in the first line, geoeconomic in the second one, and we're going to decompose the effect of these shocks by channel. We will have a direct effect thanks to the Taylor-Sharp indicators. That in the case of geopolitical one, relating, for example, to Arellano 2008 paper, there is a direct effect, direct in the sense of widening risk spreads, just because this will affect to the default probability, so it will direct repricing. Then there are literature by, for example, he and Krishnamurti and Gavesha Mayuri, that there is a compensating global financial channel. I'm talking about the world economy in general, not to the countries involved in the conflict. So what we will find, there is no literature of what will be the uncertainty channel and the local economic channels, specifically on geopolitical. We have some hints, but we are not going to impose any restriction. So what we will have on the geopolitical shock, it is a compensating effect, what we call the scissor effect. In the case of the geoeconomic shock, what we find is that there is not such a effect on the default direct effect probability. So we will have a positive, a negative shock in terms of risk, positive in terms of increasing spreads, but lowers that, for example, the geopolitical one. We will have the same global financial offsetting component, but this shock will be bypassing the direct and mainly operating through uncertainty, as reflected in Pastor and Veronesi, and through the local threshold amplifiers. This is what we want to test in the paper on 4 different events. Okay. On the 3-layer system, what we will do, it is first, the first layer is about the estimation, and we decided to, we opted by nonlinear machine learning models, and there are some reasons for that that I will explain later. But when you use this machine learning methodology, you will have to prepare to interpret the results because of the traditional or the standard black box critique of the result. What we decided to use is the Shapley-Taylor channel decomposition. At the end, we will decompose the channels, the geopolitics and the geoeconomics in direct effects and the interaction effects of the geopolitics with the rest of the channel, which is the global financial channels, the uncertainty, and the local economy. Last but not least, given that we will have there is not a structural identification by these models, we will take a lot of time, a lot of space in the paper to cross-validating this with the panel local projections and with sign restricted narrative SVAR. This is in the appendix of the paper. I'm not going to take too much time today, only one. So the first thing to know is why we decided to use nonlinear machine models. And the first and most obvious reason, it is when you see, for example, the geopolitical risk index by Caldara and Jacobello, as well as their trade policy uncertainty. These are the standards indices used in the literature. But for the people who like econometrics, you will immediately feel something. It is that these time series are highly nonlinear. In fact, the second one is like a heart attack. Okay, so and this has the 2 problems. The first, traditional problems with nonlinearity, spikes, regime breaks, time variant volatility, asymmetric tail. But there is some people introducing this model, these indicators in linear models, and this complicate a little bit the situation because you could have problems with the estimates across regimes, crisis tail effects, the country heterogeneity could be hidden in the model. So we have two options. One, it is that most of the people have been using, it is that using traditional linear model like VAR, but using the quantile version that are a little bit more suitable to deal with non-linearity. And the second one, it is to use these new techniques, the machine learning models that we use. Okay. So what we decided to do, we have no a priori, no prior of which model will be better to use to deal with geopolitics and geoeconomics. So what we do, it is a horse race competition for this model. So basically, we have a set of models, including OLS, traditional OLS regression, regularized model, including last sort rates and LSTMnet, reduction model like principal components and factor models. We also enter in the non-linear models with ensemble tree models, including gradient boost, bagging, random forest, extremely random trees, and multi-layer random forest, as well as deep learning. So what we are going to do is to be pretty aseptic and check the results of introducing this, of checking these variables. One thing which is very, very important, and I think some authors are not taking into account seriously, especially, for example, with the large language models, is that when you use machine learning models, there is a condition that you have to fulfill, and it is that they avoid the traditional bias variance machine learning problem. It is called memorization if you are using large language model. So you have to avoid the leakage between the trade and test sample, because these models are very good at mimicking in sample properties, but then you have to check across sample. So what we do here, it is to estimate the model from 2028 to 21. Here we fix the hyperparameters, okay? And we are adding time to the training set, okay, day by day. And then we run the evaluation of the model during the test set, okay? But we also leave a blank space, given that we are using 28 days models. So by given that our data are not daily model, but 28 geometric average, we even take care of that this 28 period, it is isolated of the potential of the leakage model. This is the traditional Mulay-Nathan Ramachan condition. Okay. By the way, we are not interested in our case in the forecasting nature of the exercise, but we are going to use finally this model in sample. But even we are going to use it in sample, we want to be sure that the model is robust to these problems of the contamination of samples. Once you have estimated the model, you have to deal with the Shapley values, with the interpretation of the results. On what we use, this is the map, the first graph, it is for Israel, is to use the Shapley decomposition of the sovereign risk between the explanatory variables. The Shapley values include direct and indirect together, and for every point in the model, you will have the decomposition in the base value, okay? Which, remember that our time series are standardized, so it is basically 0. And the main effects direct, and the interaction between the variables also. So what happened in this graph, it is that as you see, the situation before the Hamas attack for Israel was in the safe part of the story, so risk was even below the long run average, which most of the components, political, geopolitical, macro, and so on, operating in the safe part of the story. Something happened, which is a shock. And then all of the components of the model start to deteriorate. This is one of the characteristics of our results of the model. For the countries involved in the conflict, there is a broad-based deterioration. So it's not only about the deterioration of the purple area, which is the geopolitical one, but also the yellow, which is uncertainty, and the green ones, which are the macro, local macro activity and interest rate, deteriorate. The only potential isolation it is for the global market variables. In this case, at that time, the global monetary policy was also contributing somehow to risk, not because of the event, but because of other conditions. But we have, for example, global volatility contributing, compensating so far. So, but this explain the contribution of every of the variables, but if we want to enter in the variables, in this case, for example, we will try to decompose the purple one, which is the geopolitical one, between direct and indirect effect. We have to use the subtailor decomposition. You will take a little bit more on the computation. You can take 4, 5, or 6 days computing all of the iteration, but you will decompose the geopolitical shock, okay, in the equation, in the direct effect and the potential interactions between global financial variables, the uncertainty variable, the geopolitical, the geoeconomic uncertainty variable, that is trade and economic policy uncertainty, as well as the local. And these are the result of this shock, of the Hamas-Israel shock, just after the shock. And this is a global graph, so all of the countries are aggregated here. What you will see there, it is that immediately there is a direct positive effect on risk. In the rise that it is higher than 0. And this effect, it is permanent, more or less. And in the case of Hamas, of Israel attack, there is some, the financial market were not compensated too much, but the rest of, if you remember, we did have not a prior on the local uncertainty. This case were close to neutral. So the Hamas-Israel attack was more about the direct effect, but the global financial market were not amplifying the shock. Later, we will show the additional shocks. Finally, what we will do, it is I'm not going to enter in detail, but with these theoretical priors, we also check the structural VAR, and this is the VAR sign restrictions for the geopolitical and economic shocks that we will show the results later. So let's take now some time describing the empirical results. The first is the result from the horse race competition of the machine learning models, and the main result it is that well, here in the table I will describe a little bit. Models are ordered in terms of complexity, so from linear regression, the first model, to the deep CNN neural network model, and the last part it is populated by the random forest and the neural networks one. We have a benchmark model which is only introducing the financial variable, that is the VIX and the global 2-year note. Okay. And we have the new extended model with the rest of the variable that we have built up with in our database with the sentiment and uncertainty techniques. The first result it is that most of the models improves or reduce the root mean square and the errors, but not uniformly. The linear models, in the case of the linear models, we have from 5 to 10%, depending of the model, root mean square reduction in the model. But when you use the tree ensembles, that is that the non-linear models, this advantage can increase to even 15, 20%. Finally, the model that we use is the extremely randomized trees. We decided to use the multi-layer random forest because it allowed us to differentiate between advanced and emerging market models. There is another insight from this it is that the way that you introduce test variables also it is relevant. Given that these variables are highly nonlinear, as we saw before, introducing these variables in this nonlinear model, we will give you more benefit in terms of economic analysis on empirical results. Okay. The second important result is that we have been living with the geopolitics and geoeconomics during the last 5 years in the international economy, and we wanted to know, okay, geopolitics, we are navigating uncharted waters on geopolitics and geoeconomics, but is this really relevant for the sovereign risk, or maybe for the capital flows, or for the financial assets? And the answer, it is provided here with the Shapley values of every of the variables, so the contribution to explaining to risk, ordered by the relevance of importance. You will see country by country, which is the gray balls, but if you want to read regional average, here you will have the dark blue is the advanced economies, emerging Latin America in green, Asia in yellow, emerging Europe in light blue, and Middle East in purple. The average of all of the full variable across the world, it is the square. So the first important result that we think is that we are not discovering nothing new. It is that the most relevant variable are the global monetary policy rate and the global financial volatility. And this is the same result that Mr. Calvo, Guillermo Calvo, found 20 years ago, and Helen Ray and Silvia Miranda Agripino have been focusing in the dilemma, not trilemma literature. So the most important variables are the global ones. The second important variables are the macro ones, which are, by the way, who determine this debt dynamics equation, which is the local interest rate sentiment and local economic sentiment. And these are followed by the geopolitical and economic risk. Of course, there are some heterogeneity. For example, if you see the geopolitical risk, you will see there are some regions like Middle East and, for example, emerging Europe, which is close to the Russian-Ukraine conflict, in which this effect is higher than, for example, the local economic sentiment. But with some heterogeneity in the result, you will see a pretty robust explanation of what matters in terms of the sovereign risk. That means that geopolitics is not relevant at all, that we should forget what is happening in the world, and the question, it is not. And the answer, it is because geopolitics, and this is why we use sub-Taylor values, is highly state dependent. So it could have a small effect in isolation, but could be very powerful in interaction with global financial markets, for example. Let's see an example. This is an example of how a situation in which the first graph we have economic policy uncertainty and geopolitical risk together, and the additive risk for these two variables in isolation. What you will see is that the z-axis, which is the contribution of risk by these two variables, is almost flat. So in isolation, these time series steps for the country involved in the conflict won't have too much effect. But the things can change if, for example, you are moving now combining economic policy uncertainty with some global financial volatility. If you move to the tension part of both indicators, you will see that the pattern of risk, the shape of risk, will increase significantly, especially for the high values. And imagine that for some reason, the central bank, this is what happened in the Russian-Ukraine, decided to add or to counteract, for example, the inflationary pressures, or they think that the situation is worse than and need to be counterbalanced, of course, with all of the specificalities. This is the last graph. You have the global financial volatility combined with the global monetary policy rates. Okay? These two variables are fit each other, and this will generate risks of in the scale of 3 standard deviation, which are much more complicated. I will elaborate of what happened during the Russian-Ukraine because has been used, taken as an example of what could happen now during the actual conflict between Iran and US and Israel. And this is an example of how a geopolitical, exogenous geopolitical shock, which is the Russian invasion of Ukraine, can morph in systemic financial crisis. It is a history of the sequence of events during the Russian-Ukraine event. On the neighborhood, we will show the Shapley values for Russia and Ukraine in the first column. These are the countries involved in the conflict. And again, this has this originator penalty. So it's not only about the geopolitics, what deteriorates, but the rest of the economy, the macro one, and so on. In this case, the global financial transactions in blue were only operating in the negative side of the story. So we have bad luck, let's say. What happened it is that this geopolitical shock in purple for the neighbors, for example, start to contaminate and increase the uncertainty shocks in yellows for most of the countries. This is also accompanied with the deterioration local macro shock condition because after the policy uncertainty increases, inflation and interest rate start to replace. And this finally reach a break-even point in which the VIX and the yields amplify the effect. So it is when the blue lines especially cross the zero line and start to amplify the crisis. So this is the typical example when some exogenous event like the Russian-Ukraine finally ends up in a more systemic potentially worrisome situation. Okay. In terms of the analysis of the composition, direct or indirect effects, this is what we analyze in the papers, but we use placebo tests and so on to also to confirm that it is not a causality that all these 4 events are the only ones. But you see here the 2 geopolitics, Russia-Ukraine and the Hamas-Israel that I presented later. And in both, what you will see it is this scissor effect. So it is in red, the direct effect, always immediate and positive and permanent. And the blue one somehow offsetting. In the case of Russia-Ukraine, at the beginning was offsetting a little bit more. In the case of Hamas-Israel, in terms of globally, this is the average global. And in the second one, what you see in the second row is the US presidential election, which is a proxy of geoeconomic uncertainty, trade, and the second one is the Liberation Day effect. What you can see it is the direct effect in red are pretty stable, the similar levels that before the vertical line. That the blue one is also like in the offsetting some of the tensions, like in the geopolitical one, but that it is that the local ones and uncertainty one that start to move, for example, in the liberation they start to increase. There is another interesting result, which is that we can use the direct effects country by country to measure, for example, the gravity effect. And you have here the equation on whether the distance to the conflicts matter for the countries to experience the direct effect. And here you can see the 2 geopolitical events in the paper, which is the first is the Russian invasion. So it is in the horizontal axis is the distance to Kiev, and the direct effect in the vertical axis. What you will see it is that the direct effect is much more important in the blue countries, basically advanced Europe, and lighter blue in the emerging Europe. But countries which are far from this situation will experience the direct effect in a lower manner. This is the case in a lower way. This is the case in emerging Latin America and emerging Asia. When we see the Hamas-Israel attack, we find more or less the similar. So
Well,
the closest.
Alvaro, we have a question from Jamel.
Yeah.
Thank you, Álvaro. Thank you. Very interesting about the distance. Sorry to ask a second question. Did you try the geopolitical distance? Because, for example, the US is very far from Israel, but in terms of geopolitical distance, they are allied. So something is happening in Israel may impact repricing more directly. The same as goes for China. So a complementary exercise for these very interesting charts would be also to replacing physical distance with a geopolitical distance, actually.
Or economic distance. We didn't try, but you are right in the graph. For example, it is very clear. You see that the gravitational effect of the Russian-Ukraine is higher than the Middle East one. And the reason it is the oil price connections, maybe with Asia.
Yeah.
But you are right.
Thank you.
Finally, we have an opportunity, and unfortunately, opportunity to test the model with a new event, which is and the question here is, does the seismic effect hold during the US-Israel-Iran conflict? We have now 80 days. We have not completed the 3 months, but we have the 80 days. And what you can see on the very right of the graph, it is the Iranian attack. And the history, you know that there are some people still saying that we have been since the end of February during the conflict, but the markets, the global markets, have behaved very loosely and very bullish. There are some doubts of the potential effects of the shock. Well, what we find here, it is that the shock has the same direct effect, pretty similar to the previous shocks, to the Hamas-Israel and the Russian-Ukraine, even that it has been maybe more complicated and more severe because of the countries involved in the conflict. But the global financial side has behaved offsetting almost everything or what happened. We are believing in and I will explain you why in the next slide. Why is that? Okay. So how the seismic pattern work again during the US-Israel-Iran conflict? So and these are the 3 important channels during the last 2 or 3 months. Okay. The first is the direct effect. We started with the pre-shock. We were already navigating in some positive effect, and this reached a peak of around the first month. Okay, and that's so far has been relaxing. The latest date it is May 20. It is on there. So the direct effect. One of the positive news is the direct effect is also relaxing in the global aggregates. Why the markets have not amplified the shock of what we experience in there is an important channel or move and so on about the global. These are the following graphs on the right. The first is the global yield. The global yield have started, but it increased to near 4% last week. According to this diagram, what happened is that it didn't reach enough levels to amplify the transmission. So moving to the right to the zero value. So we have been living in the absorption area due to the global yield, and if we move to the VIX, to the global volatility, it has happened something pretty similar. We have an increasing short-term impact on the VIX, but it took levels of 30, so it is one standard volatility and has been relaxing. So What would you need, for example, for the global financial markets to contaminate this shock and amplify the effect? Well, you will find, according to these diagrams, more or less higher rates for higher period of time, around 4 to 5 permanently, levels of global volatility rather than 30 that we are now, and we are now, for example, even in the pre-war levels of near 40, 30, 40 more permanently. So as long as these variables don't remain in this stress area, what you will find it is that you will find the size of patterns. So global financial channels mitigated in general terms, not for the originator countries, the global financial situation. And we think that this is important to know for the policymaker. It is important to vigilance the first graph, so the direct impact, but we should have or to keep another eye looking at what's happening in the global financial markets and in the global rates, because this has the facility to amplify very easy or to offset, like in these cases, the tension situation. I'm not going to add there too much, but this is the structural sign restriction that we use to confirm the validity of our results. This, if you remember, the a priori restriction had been imposed. What the structural VAR panel data model shows is that the geopolitical shock have in red a positive effect, which is compensated in blue by the global financial channels, and the local and uncertainty are more or less not distinguished from zero. But in the case of the Geoeconomics uncertainty shock, what you see is that the direct effect is much weaker. The global financial channel operates in the same way. And remember that after the Liberation Day and after the Trump election, markets were very bullish, compensating all of what happened. But you can see here that it is uncertainty on the macro channel which operate stronger, okay, after the liberation day, for example. So our last slide, it is about the policy implication. I think that it is important to enhance the policy toolbox of with this indicator, with the geopolitics and geoeconomic indicators, and text analysis provide a good solution, given that there are not too many numerical indicators for these two events. So it's important for the central banks to take to use this real-time database to our or another databases to monitor the geopolitics and economic shocks. And it is important also to know the decomposition, the Taylor-Sharp decomposition, because it is not the same that the direct or indirect effects are at work. The policy implications are quite different. For example, if it is the direct sovereign, direct geopolitical channel which is at work, which is affecting the sovereign repricing, then liquidity and central bank policy could be insufficient. That will require diplomatic de-escalation, institutional strengthening, or even fiscal policies to tackle the negative effects on the vulnerable people, as for example, some of the central banks, including the European Central Bank, it has been, or some of the countries in Europe doing. But it is the global, if the global financial channel, which is it is behind the widening the spreads, here it is where there is an important room to central bank liquidity swaps, for example, to calm down the situation. And this is all what we wanted to say. It is a dense mix of techniques and policy implication of what is happening during the last 3 or 4 years, and I hope you enjoy. And the floor is yours for your questions.
Thank you very much, Álvaro, for this fantastic presentation. So I will ask to the attendees to raise their hand if they have questions. And I will just ask mine. I mean, it's well known that I mean, yes, I will ask this maybe after. But yes, I have one question about Israel. So some geopolitical shocks in Israel led to a decrease in CDS. How does it fit your sign restriction?
Okay, sorry for the, I think that the map of Israel is here. I decided the graph, it is only showing just the aftermath of the Hamas-Israel attack. But I have to say that it was the reason before the end of the last year, 25, this was converging to more or less to neutral. So basically this shock, this geopolitical shock has been abated in terms of the sovereign risk. It has started to increase, not so, for example, so dramatically as it did after the Hamas terrorist attack. So maybe because it was somehow expected by the markets and so on. So it is now a positive risk. We can send you later the recent Israel graph, but it is not in such a permanent, let's say, with such a permanent impact.
No, yes, for sure, it's not standard behavior, but when it happens, when you have a geopolitical event that is against your sign restriction, in general, not only Israel, what's happened?
In general, what you have is the first is the immediate shock, the surprise, which is the purple, but then everything starts to deteriorate through expectations. So it is the macro, the macro. So your trade will be affected, with your networks, your situation will require. The situation was pretty hard, I have to say. Uncertainty, which is in yellow, will increase very rapidly. Economic policy uncertainty, while the government will do just after this attack. Remember, you are living in Israel, so you know perfectly on that. And probably there will be expectations in green that this will finally affect to economic activity. Okay. And the increasing rates, maybe increasing rates also, I don't know, to sustain the exchange rate. So it is, for me, it is pretty normal that the effects will be broad-based on the whole spectrum, except the global ones, which are the New York ones, let's say, of the Wall Street ones. This has been happening in all of them, in all of them. So this is something also here in Russia and in Ukraine has been happening, also has been deteriorating in the US, Israel, we don't have Iran in the model in the same way, but in a weaker, not so strong way this time. But it is something that I think that should be justified by macro when you enter in a conflict that you deteriorate not only the geopolitical part of the story, but also your local macro conditions and expectations and uncertainty and so on.
Okay, thank you very much. So I think we have some questions from Jamel, which is also a specialist on geopolitics. So Jamel, please.
So sorry for asking all of this question. The slides and the work is so interesting. My question is about, you have a recent literature that identifies geopolitical risk shock as supply shocks, which tends to increase inflation and will require higher yields because, of course, the central bank will react. And on the other end, you have the local uncertainty, economic uncertainty, which is called Geoeconomics here in the paper, which can also affect the economy like a negative double shock. So my question is, I like very much this nickname by the scissor effect. But my question is, do you think that actually the scissor effect is a kind of this geopolitical or geoeconomic shock are a mix of demand and supply shock that explain they have this different effect. And may somehow answer to the question of Jonathan. So identifying very carefully which is a geopolitical risk which affect the supply side of the economy and what will affect the economic sentiment and economic uncertainty, more the demand side of the economy, will be very, I think, important to frame this scissor effect. What do you think about that?
I have the feeling that the red one is supply shock, the geopolitical ones. I'm not so certain about the rest of the shock. But one thing that we could do, and we are thinking to do it, it is to combine that this structural VAR analysis, which practically mimics what we have using machine learning, to implement the identification not only through geopolitics, through this channel, but the traditional supply and demand shock. And if the supply shock, it is pretty similar to the geopolitical shock in this case, this will be the confirmation that this is mainly a geopolitical shock. For the rest, we could identify, for example, what is the well, the second is a purely global financial shock, but especially for the second ones. I didn't do it. I have the suspicion, like you, that this is a pure supply shock, and this has enormous implications for policy, which are pretty similar to what I commented. Yes. It is that maybe it is not the right way to raise rates and so on if this is the sort of dominating, and the only thing that you can do it is diplomacy and try to tackle the vulnerable group to enhance the safety net and so on. I have this suspicion, but it will be very interesting to confirm this.
Thank you.
You're welcome.
Thank you, Jamel, for your question. If you have any other question, Jamel, feel free to raise your hand. Now we have a question from Evangelos Stravelas.
Yeah. Hi, Benjamin. Thanks for this opportunity. I have a question here. I was just listening to your talk, and I just make a thought. The Shapley tailored decomposition partition predicted variance, and it does not actually identify causal channels. The seasonal pattern is observable equivalent to a mechanism. This is my thought. Geopolitical shocks in your Shable triggered flight to safety, compressed the 2 years U.S. Treasuries, which is your dominant predictor by Shapley weight, and the global financial crisis component turns negative by construction. The four narrative events you have validate a forward channel taxonomy, which I found that exhausts the degree of freedoms. My question is, what restrictions does the forward channel structure impose on the data that the single US rate mechanism story does not also satisfy?
Okay, the only this is an accounting exercise, basically. So what you decompose is the forecast between the base values, the main values, and the interaction. And I think that these interactions, the composition is highly interesting because you can precisely decompose the contribution. One of particular and good properties of the Shapley values and Taylor values, it is that they are purely additive. Okay, so we can do it throughout the individual channels and also by country, so that we can decompose on the second, for example, this is on the second equation, the direct, the contribution of the direct and indirect. In this case, we decided to sum up some of them. For example, global financial channel includes VIX and the rates. Uncertainty includes geoeconomics uncertainty, economic policy uncertainty, and trade policy uncertainty, and the macro interest rate. But you can configure the decomposition. So I think that okay, maybe it is not structure. This is why you will need all the cross-validation using your linear with local projection and so on, and we dedicate a lot of time to this, but it has this advantage. And for us, this is very important. The case, in my personal opinion, okay? This is very important. This is not the same that the economic policy uncertainty and geopolitics happens in a world with the bullish markets than the bearish markets. So the difference could be significantly different. And I think that for policymakers, it is very important to keep an eye on what's happening in Hormuz, but it is even more important to keep an eye what's happening in New York, London, and Hong Kong. For example, because this has the power to amplify notably what is happening in Hormuz. And I think that this is one of the lessons and the complexity issue, and why the machine learning models are very well prepared to capture these interactions and nonlinearities. So this is a personal opinion.
Thank you very much, Evangelos, for your question. So as my Shapley decomposition expected, we have another question from Jamel. So please, Jamel.
So sorry again. Thank you, Jonathan. I have two additional points. The first is about the question of nonlinearity. I think, Álvaro, you rightly insisted that these shocks are nonlinear, both in terms of state dependence, in terms of transmission of the shocks. What is interesting to see is that actually there is interaction and nonlinearity with the state of the financial markets, less volatile or more volatile, but also with the level of tensions. Think about what happens, because I use your trackers, your BBVR trackers in my research, and in my lectures at Skeba Business School, and I taught to my students, think about 9/11. The 9/11 happened during an era where globalization were very smooth and resilient. Think about 9/11 happening now. The consequences will be much more dramatic. So I think there is also a state dependence to the level of tension and the regime in which the geopolitical global arena is. We are in a much more tension phase now with this rivalry between China and the US. So my second point is about, you know, when you rank the chart between the different drivers, there is some trackers in the BBVR database which are bilateral. Something that would be very interesting is to see in the small part explained by the geopolitical risk, which are the more important relationship, China-US, US-Japan, China-Japan. That could be a very interesting exercise. So those are just two complementary points. Thank you so much.
It is a 9 point, and I will take a note of it. Well, first of all, thank you for using our data, because it is important for us that dedicate a lot of hours, but it is important point, and there is a lot of information with the indicators and inside of the analysis obtained by the Shapley values that with different combinations, thresholds to do. I saw, for example, for today, this Iranian threshold. So what will we need for markets to amplify the level? So imagine it could be a permanent 4.5 or 5% yield in the 2 years note, combined with 45 or 40, 45 permanently, can give place to a very, very different situation in which we are fortunately from the part of the markets now.
Thank you very much for your question, Jamel. And now we have a question from Charles Lichfield.
Hi, joining you from the belly of the beast in Washington, D.C., another place where geoeconomic uncertainty has been caused of late, and so that is the rationale for my question. Thank you for your presentation. was very interested in what you said about decisions interacting and exacerbating the problem. I was wondering if you had any preliminary recommendations to policymakers on how to minimize the negative effects of their own decisions in light of what you see in the data. And I mean, it can refer to anything. My personal work brings me to look at things like sanctions and export controls. But I mean, I'm not asking you to make a specific comment on specific policies, but rather just in the geoeconomic era, what should a policymaker understand from your research?
Well, it is basically commented on this. It is the first to enhance the set of indicators in test in real time, if possible, and test allows for that. The second, it is try with this technique or whatever to understand what the hell is going on, to identify the macro, the markets, the geopolitics, which is the neighbor, and so on, to disentangle what is the dominant force and what are the potential interactions between the variables. And once you have, if you have finally a clear way, take the right decision. I mean, so far, not that many central banks have reacted to the upside, maybe only verbally, and this is maybe the right decision. And they decided, for example, in my country, but in some other countries too, to couple some of the problems with gasoline or whatever, with the people, reducing with the VAT and so on. So basically what they did is to use fiscal policies to tackle, to limit the vulnerability, let it go a little bit. But they also, I understand, they are central bankers, so they are inflation targeters, or inflation and growth targeters. And they should also to remain vigilant that the inflation generated by the conflict doesn't contaminate to another type of crisis and so on. But I would recommend this. It is that keep an alert. So far, I think that among the bad things that this crisis had, it is that the global markets have not been amplified like this, and maybe this gives you some time to react before to start to react and to avoid what happened after Russia, Ukraine. So I'm not, of course, every economy and every inflation will be different, but that will be my recommendation. Because maybe I hope that someday and sooner than later that the geopolitical crisis could abate. And maybe what we will have is a rapid deceleration to inflation to the normal levels, and maybe we can avoid a more let's say tightening conditions to the system. But of course, I'm not entering in that potential second crisis, which is the inflation crisis. But I think more or less the central banks are following these guidelines, which are described here so far. But let's see what is happening.
Thank you, Shar, for your question. We have a question from Ming Xuan Zhu.
Hi.
You are on mute.
You are mute.
Oh, yeah.
Yes.
Thanks for your presentation. It's very nice research. I have a question about that. Because I saw one of your slides mentioned that local economic sentiments variables. Is that right? And I consider that like the local economic sentiments variables when you process the data sets like sentiment analysis or narratives, it is related to the global financial cycle, especially shocked with the geopolitical risk. So I'd like to ask that, do you have any question, do you have any suggestions that how to separate the content for the specific indicator like local economic sentiment variables to avoid any overlapped contents related to the global financial cycle?
Just one thing I forgot to comment, and Tomasa will come describe fully in 1 minute. It is that by economic sentiment index, we call it economic activity sentiment index. So this, for example, these indices on the right, it is how the business side, especially the only economic activity, not including inflation and so on, what is the perception in the media about the business cycle position. And so far what we found here, this is updated to the last to the last week, it is some weakening position for the developed countries, a much bigger one, of course, in the North African Middle East, which is consistent with this gravity and so on effect. Some others weakening situation, but this is related to the Russia and so on. But the index is precisely on economic activity only. The one in the middle, it is the standard Nick Bloom and Baker and Davis economic policy uncertainty, which is slightly different. We use, for example, the right one, the economic activity in our channel macro conditions, and we use the economic policy uncertainty in, maybe it's not precisely correct, as a geoeconomic uncertainty index, together with the trade policy uncertainty, but they are different both. Tomasa?
Yeah, and regarding your question and the methodology we follow to build the indicators, first of all, what we take into account is, according to the URLs, we identify the media sources that are coming from the national media and foreign media. So with this, we identify this local and foreign indicator. And according to each media, for example, the national one, we are looking for this set of topics or keywords that we would like to look for. And also, we are asking at least twice that the country appears in the news article. So if it is speaking about global conditions, we also are like asking for twice the country appears. So it means that this global condition is affecting to the country. But if the country does not appear, because it is speaking about US and we are in an European country, we are not taking this article into account for building the indicator.
Yeah, thank you. Thanks for your interpretation. Thanks.
Thank you for your question. Do we have any additional questions from the attendees? Okay, so I will just ask 2 questions. So first question is the kind of endogeneity. Yes, so David, I will give you for 2 minutes. So my first question is about more the endogeneity. So news are reacting to real facts. So the movement of CDS are not coming from the news; they are coming from the facts. The question, and not not necessarily from the sentiment, but from the facts. So you would have to clean the signal from the facts to extract only the sentiment and to say the sentiment is impacting the CDS. So my question is, how this kind of endogeneity? And a second question I will ask after David.
Well, it's not difficult to fully separate. Remember that our measure of risk is the credit default swaps, sovereign credit default swaps. So this is a variable that quote in the market minute by minute, and will be also influenced by what traders read about the situation of the country and so on. So, but this will be a potential issue to fully separate the endogeneity problems. We deal with some of them in the appendix with some of these problems with the bootstrap addressing the generate more problems and enhance the robustness, but it's still an issue, can have a potential issues, and we try to limit this possibility, but we still have to think on it to fully separate.
And regarding your previous question about how, if the geopolitical shock is affecting to decrease CDS, sovereign risk, we should take into account that we are just using machine learning approach and models. So design is changing according to the indicator. We did this part of the design restriction model just as a robustness test in order to see if the results keep the same or not. But in the machine learning, if the geopolitical shock is affecting just decreasing the risk, it will take it into account in a really dynamic way.
Before giving the floor to David, because he has a question, I hope you still have, David, your question, right? Because your hand is not raised. Okay, great. So before, I just want to imagine this this experiment. We have a geopolitical event, but we have no news on it. How would react the CDS according to your model?
Well, for the global financial conditions.
Maybe indirectly through the other through the mixture of the other channels, but at the end it is part of the variables of the model. So unless you have another variable reflecting this geopolitical shock, it will not be directly in the model because you impose that restrictions that only not included. But maybe what you will find it is the movement, but I guess that the movement in the rest of the channels will be exactly the same. Okay, so imagine that you don't have this, the red one here, okay, but you should have these ones. You should have a decreasing of, for example, global financial conditions and so on. Maybe you don't know why. Your full picture of the movie it is incomplete because you don't know what that geopolitical. But you could have not only a sentiment. You could have an index proxying the situation or some. I don't know. I didn't think. Enough about it, but one of the things that is good about the test analysis is that at the end it allows us to have these variables. So because 10-15 years ago we didn't have this on daily basis. We have some indicators from annual and so on. You have to wait a year to see some international relation policy institute to present the statistics on it.
Sure. Okay. Thank you very much. So we have a question from David Park.
I'll keep it very concise. So I'm curious as to what managers and investors can learn from your research.
Well, I think they can learn a lot. The first about the individual indicators. So for the first time, you have a place. There is another place as well that you can monitor what happened or not. Everybody knows what is happening in Hormuz Tuesdays because this is fully in the media. But we have 69 countries, and sometimes there are things that you cannot see. So let's say weak signals in countries which and can complicate and contagious. So this is an important thing. So it is not only the Iran situation, what is happening in Israel. The second, it is that they can do analysis as well. And we show that this could be a very nice analysis, tackling nonlinearities, tackling threshold levels. Finally, you can convert this to numerical levels. And to give also even the traders and so on, which levels could be critical to to amplify or to relax the situation. I think that there are a lot of things that we can do, and also this for traders and for investors. But this is not the long-run structural analysis on geopolitics. This is more about what is happening on daily basis and how these things can evolve. That is something that maybe markets need it more than the structural, the kind of structural analysis that maybe, I don't know, the specialists of the sovereign rating agencies can do. So look at the things on the real time and how this can operate together, some shocks at the same time, and what will be the implication. I think it's a lot. This is the beginning of more series on geopolitics and also using LLM, but I think it has been very useful, at least for us as a bank and for our clients.
Thank you very much, David, for your question. Okay, so if we have no any other question, I will ask my usual suspect question. So we are a central bank, and we have your paper, your data. How could we use optimally the findings, but also the data? The data, I think I have some ideas, but how could we use the paper as a central bank, not as a policy maker, as other policy makers, as a government or something, as a central bank, pure central bank?
I think that you can use the indicators individually just to have a flavor of what is happening in the world in combination with the world financial markets. I think that you can look at the interactions between the factors and the countries, so contagion between the countries and between variables. And you can also, for example, we have an internal site that under request can be accessed, in which we monitor in real time these Shapley values, the decomposition. So we know at every moment what is driving the risk of our countries. So could be this paper is about geopolitics and so on, but in many other occasions could be locally politics, what is mattering or macro conditions. Things about the interactions. We have been used to use orthogonal models which separate the shocks, but rarely these shocks happen individually. There are multiple equilibria in the literature, so it is important on how these shocks move in the combination. I think that many things that you can do as a central bank with this information. I hope.
Yeah, of course. No, the data and the results are fantastic. So if we don't have any additional questions from the floor, I will thank you again for this presentation, for the data you are making public for all people. It is very important today to make this kind of public good available for all the research community, and I think you did a great job also for this. So thank you very much for the presentation. Thank you very much for all what you do in terms of making available this huge amount of data. And I hope we will invite you for another very policy-oriented paper like this one.
Thank you very much for the opportunity to share our work with all of you. Thank you.
Thank you.
Thank you very much.
Have a nice day.
Have a nice day.
Bye.